Hey everyone, it's Friday and I'm back again to dish you the hottest and most leading news of the week. So guys, I welcome you to the first episode of our June 2022 weekly market insight series, which is coming directly from our capital markets trading desk right here at SunWest Mortgage Company. Dive in with me into the world of news and let's see what has happened in just 1 week. Okay, so the U.S. economy is showing signs that post-pandemic surge is beginning to moderate. Stocks are near correction territory, geopolitical tensions are elevated, and prices are higher everywhere. So to fight this, the Federal Reserve would undoubtedly like to see a more rapid decline in inflation. However, as the Fed sees growth is slowing, it softens its recently hawkish tone, providing some relief to both the bond and stock markets. U.S. equities started the week in red, but gathered momentum as the weekend approached. Treasuries also followed a similar pace throughout the week as they dipped from their early highs, but rebounded ultimately. So let's see what else is underneath the surface, shall we? The Federal Reserve Beige Book survey released Wednesday and reported a slight but continued growth in the U.S. economy. However, 4 districts noted that the pace had slowed and 3 cited growing fears of a recession. It also mentioned that uncertainty about the economic outlook is causing some businesses to pull back on spending and investing. At the White House, a rare meeting between President Biden and Fed Chair Powell was held, where Mr. Biden clearly declared that he's respecting the central bank's independence of decision-making on policy tightening and shifted on responsibility for taming decades high inflation on Fed's shoulder ahead of November's midterms. No doubt, U.S. tight labor market has contributed to inflation pressures, and it puts jobs data in focus. Thursday's data showed the U.S. private sector job growth softened in May, with payrolls rising by only 128,000. These weaker than expected figures indicate that companies are still struggling to hire from a limited pool of workers. However, in the week ending May 28th, almost 200,000 people filed for unemployment insurance, which is 11,000 down from the prior week. So now, moving on to international news. Ukraine's central bank raised borrowing costs to 25% from 10% in its meeting on Thursday to reactivate policy tools to stem inflation and shield the currency battered by the Russian invasion. After months of homebound, Shanghai will finally let people leave their housing compounds as the city moves to dismantle the last remaining restrictions that confined most of its 25 million residents to their homes for 2 months. Meanwhile, OPEC met to discuss oil production policy and decided to raise output by 648,000 barrels per day in July. The White House welcomed this decision. So let's see how the housing market is doing. All right, even though mortgage interest rates moved lower again last week, application activity continued to decline. The Mortgage Bankers Association index declined 2.3% for the week ending May 27th. The refinance index fell another 5% from the previous week, whereas purchases were down 0.6%. As per a recent survey, the number of active home listings rose 8% year over year in May, probably driven by new sellers and a slowdown led by an increase in prices. However, the listings remain 48.5% below their May 2020 level, and price increases have accelerated in recent months. Finally, let's conclude today's session. All right, let's do it. Both the hawkish and dovish wings of the U.S. Central Bank confirmed their determination to raise interest rates. Doug Daly of the San Francisco Fed and her more hawkish colleague James Bullard of St. Louis both backed a plan to raise rates by 50 basis points this month and next to counter the highest inflation in 40 years. Meanwhile, Fed deployed the second tool alongside higher interest rates to curb inflation. It finally started shrinking its $8.9 trillion balance sheet after doubling its size through asset purchases in the first 2 years of the pandemic. However, taking these steps, it is not yet clear how much growth will slow, how quickly inflation will fall, or whether the economy could slip into recession. No doubt, this gathering of worries and uncertainties will take time to resolve. But don't you worry, I'm here for you. So stay connected with me every week right here. All right, everyone, that's all for me today. Until next time, as usual, stay updated with our news and our trading desk will keep you informed with our pricing incentives. Have a fantastic weekend, everyone. Buffy's out.